So now we're going to take a step ahead, and we just heard from a lot of some of the development happening on protocols. We're now going to step into the world of institutional finance, thinking about how smart money and smart contracts merge, and talking about the intersection of traditional finance and digital assets. So really excited to announce and bring this panel to you guys. These are vets who've been in the space, probably combined 40 plus years between the four of them. But I'm just going to go down and have you guys introduce yourself, what you do, where you work, and just a little bit about how your company is involved in the crypto space.
So Dave Schwed, I'm currently the CISO for the brokerage money business over at Robinhood. Prior to that, I was the Chief Operating Officer for Halborn, Global Head of Digital Assets Technology for BNY Mellon, and then CISO for Galaxy Digital, hence the 40 years, I guess, in the industry.
So my name is Owen Lau. I am a research analyst at Oppenheimer. I mainly cover equities. So my space is exchanges, blockchain, and information services. So Robinhood is part of my coverage.
Let's talk.
So good company.
Hey everybody, I'm Christine Moy from Apollo, which is a $750 billion asset manager focused on equities, private credit, and insurance. I'm a partner focused on digital asset data and AI strategy, and have been here for about 3 years. Previous to that, I was 2 decades at JP Morgan and built and led their blockchain program.
Nice to see everyone. Ed McGee, I'm the CFO of Grayscale Investments. We are a wholly crypto or digital asset focused asset manager. We have about 25 billion of assets under management, so we're not quite where Apollo is just yet, but
soon.
That's right. We're focused strictly on this space. So all comments about Ethereum or Ether aside, we do have about 12% of our assets under management in Ethereum. We are the largest franchise of ETH ETPs, and bringing this concept of staking inside an ETP is something Josh and I have talked about for a long time. So good to be on the stage here.
My first question is going to be to Owen. And Owen, you spend a lot of your time sort of, being sort of a scribe and helping the traditional world understand what's happening in crypto. Actually, you and I collaborated on a staking primer right around the presidential election that was published to your clients. Can you set the stage in terms of who your clients are and how they're currently thinking about crypto and digital assets and sort of what's top of mind for them right now?
Right. So first of all, that was a very good report, and thank you for that. I felt like I should moderate this panel, and you should be sitting here, honestly. So again, like I talk to a lot of traditional investors. My clients, or I should say there are 2 types of institutions. The first one is more about the market structure, exchanges, brokers like Robinhood, and then market makers. They know this space very well, right? If you ask Robinhood, they know staking, they know crypto, they know this space, they are the distribution channels. So they are ready to get into this space when we have the regulatory clarity, right? So that's the number one roadblocks for them. But for investors, because I talk to like many TradFi investors and stuff like that, not many of them are crypto native. So I would say maybe like last year, 10% of my conversation was related to crypto, blockchain, and Coinbase. This year, that number went up to around 40%, which is good. Which is good because I felt like more and more people are aware of that, and they need to have a view on whether they want to get into this space, right? Last year, they can say, oh, because of SBF, because of bankruptcy, I can avoid this space totally. This year, they cannot. They have to have a view about whether they are bullish or bearish on this space. So that's why I think this is pretty encouraging.
And I have a follow-up for you, Owen. We sort of talked about this in the primer, but if you were to introduce staking to an institutional client, how would you draw parallels and highlight sort of key differences from traditional finance or key similarities?
Yeah, so first of all, most of my clients are equity investors, so they don't know that staking space or whatever space very well. But if I have to draw parallels, I think the number one difference is in terms of the functionality. Staking is similar to fixed income investments. If I have to draw like an analogy, right? Staking, fixed income. The difference is staking, it's more like you provide a token that facilitate the operation of the blockchain. So you kind of like secure the network. But for fixed income investment, you don't have that capability. In terms of maturity, I think staking, you have kind of unlimited maturity per se. But for traditional fixed income investments, you do have a maturity, whatever it is, 6 months, 1 year, or 10 years. I think the last important thing is about the custody, right? For staking, just like Figment, right? You don't have to take the client's fund. But for traditional investment, like fixed income, you have to put your securities into a third-party custody so that they can protect your assets. So I felt like those are the key similarity and differences between the two.
Yeah, I think with 40% of your conversations focused around crypto, that's going to be a conversation topic that comes up more and more. And you can now plug a staking rewards rate into a discounted cash flow model and almost, treat Ethereum or treat Solana like you would any sort of traditional valuation model for.
Yeah, exactly. I mean, right now the conversation is like very preliminary.
Yes.
They just want to talk about Coinbase. Like for me, they tell me about Coinbase. Can it go up? Can it go up to $300? What are the catalysts? Can we see the bill this year? Like those are the conversations right now. But going down the rabbit hole, maybe in the next 2 to 3 years, I think more and more people will talk about staking and Solana and other tokens.
Yeah. Well, thank you. So I want to shoot over to Ed now. And Ed, back in 2022, you actually wrote a Q&A that you published on Grayscale's website. And you outlined, I think you're the first ever ETF issuer to outline the challenges around staking in the ETP structure in the US, which I think I've gone back and reviewed maybe like at least once per year since we had that initial conversation then. But where do things stand today? If staking is to be included in any US ETF, aside from regulatory hurdles, what other factors need to be addressed?
I'm upset that you've had to read it more than once because we should be there by now, but this is not uncommon. And that was fantastic. The same similarities that we see with proof of stake technology and the concept of the nearest analogy being fixed income works well for this conversation. And when Ether went from proof of work to proof of stake, myself and the team had wrote that because we just saw the potential for the ETF wrapper to handle this technology and deliver value to anyone who held the investment product in a security wrapper, so our product, or the underlying protocol. And our goal as an ETF provider is to provide that investor with 100% of the value proposition of the underlying asset. And so to answer your question, no, there are no US ETPs that stake today. They do so in other regions. They do so in South America and Canada. I think we will get there. So a lot has changed, but a lot has not changed. So what has changed? We have a different administration. We have a more receptive SEC. So since 2022, we've had these conversations around what this technology is, some of the considerations around whether or not you hold your own keys and the safety mechanisms. We've been down this rabbit hole for a while. And we're going to meet investors wherever they are on this education journey, whether they're newly evaluating digital assets or further down the cap stack and understand the utility of the technology. So we have that has changed since 2022. But what hasn't for the ETF is really what you do upon a redemption. And so there's the regulatory hurdles, which I can go into, but I'll start with the operational ones because Owen alluded to it as well, which is if you have T+1 settlement or T+2 settlement, meaning you have to settle your shares versus your Ether in 2 days' time, the unbonding time right now is beyond that. And so you have a mismatch in time. Now, the ETF wrapper has handled this across asset classes. There are long to settle and hard to source assets under the ETF wrapper in the US and other geographies. So we can solve for that. And there's innovative ways, and Figment is on the record going down to the SEC, meeting with the crypto task force as ways to solve this issue. But the issue remains. And so now that we have some of the solutions, which can be basic or they can be advanced based on whether or not you want to do financing or a validator or a liquid staking solution within an ETF, the ability for the solution to be falling upon receptive ears is finally here. So the administration has changed, the operational technology and the ETF wrapper can handle this, and now it's a matter of approval. And so we are on the record, we've worked with the New York Stock Exchange, we've submitted an amendment to our filing that allows for staking in the underlying assets of the ETFs, and we are now, much like we did with the Bitcoin ETF, in the process of working with that regulator, putting them on the clock, answering their questions, and then much like we did for the Bitcoin ETPs, we hope to be the first one to get through the door and allow investors, again, 100% of the value proposition of holding assets that can stake.
And Ed, let's kind of fast forward to a future where we have staking in the ETP model in the U.S. and you're actively earning rewards, and you've developed a product that's able to take in those rewards. It, obvious benefits of securing the blockchain, but also there's a financial benefit to doing that as well. How are your customers asking you about this today? Do you think if we were to get staking approval in ETFs tomorrow, and you guys are able to spin up validators and start staking a portion of the Ethereum in ETHE, do you think your investors care? Do you think that's a motivating factor for maybe capital that stayed on the sideline that's prevented some of the ETH products in the US to be as competitive, at least on a relative market cap basis, to the Bitcoin products?
In short, yes. If we got approved tomorrow, we would stake tomorrow. That's where Grayscale is. We are there. Is it keeping capital on the sidelines specifically for Ether? That's maybe a different question. The demand profile, the ETH, ETF ecosystem has had headwinds this year. But what's really interesting, and it goes back to a point Owen made, which was the education demand is absolutely there. And so now you see real reward rates that can add to your position. I think that will draw capital. And I think Bitcoin as the digital gold and the benchmark, there's going to be a very easy transition to, okay, Bitcoin doesn't earn reward rates unless we do something different, like our previous panelists had talked about. But proof of stake protocol provides that. And now all of a sudden you have different reward rates, you have different potential economic opportunities that can be passed through investors. I do think that takes capital off the sidelines, and we're here for it. Grayscale is going to see that cycle play out.
Great, thank you. Now, Christine, there's, we sort of just talked about, starting at investment research, talking about how people are starting to think about staking in general. I think the most basic entry or starting point for a lot of institutions and retail individuals will be through the ETF. But you are one of the largest investment managers in the world, and you've taken a stance that there's going to be tokenization and private credit are going to exist on the blockchain. Portfolio management for some of the most sophisticated investors in the world is going to end up on the blockchain. So I guess beyond ETFs, what type of alternative vehicles are you exploring? What have you guys done in this space, and how are you working with helping build exposure to digital assets on chain?
Yeah, no, and thanks. I'm really excited to talk about this. I think for those of you that have known me through the decade, it's been my life's work to try to figure out how do we tokenize real world assets and utilize the blockchain to build better products and services and experiences than we have today. So just a quick example, when I get paid by Apollo into my bank account, I kind of guesstimate, maybe this is how much my credit card bill is, maybe this is how much I have left, I should do something with that. And then if I actually got it together to do something, which I don't because I'm a hot mess and I'm working too much, maybe I would press a bunch of buttons and get them into treasuries just to get a base level yield. Or, if I was really ambitious, I'd start investing in some Apollo products, but we never get there. Now, and then inevitably, if I end up doing anything, then I have to reverse out of it because I got to pay taxes the next month. So then I have to press all those buttons and call a private banker or whatever it is that I need to do to get back into cash. And then literally all of my earnings just not utilized, not invested, not yielding or anything. Now, in a future world where we have multiple assets on chain, and by the way, the future is here, I get paid from Apollo, and I get paid into my crypto wallet. And my crypto wallet has designed for me a model portfolio that is 10% stables, 20% money markets, 25% Apollo Private Credit, of course, and 25% like YOLO crypto native yields because I'm risk tolerant like that. And so basically I get paid and automatically that pie chart, like my payment or whatever my payroll is, gets automatically distributed into that pie chart. And without me having to do anything, every cent of my earnings is being deployed, invested, and yielding. Take that a step further, I go to lunch at Nobu, and I'm like, okay, cool, like I'm gonna pay for lunch now, $100 to Nobu. That would be an automated, DeFi swap from treasuries into USDC, off-ramped to pay to Nobu, and not only is every penny yielding, it's yielding up until the last second for which I have to spend it. And now that is absolutely a 10x experience than what we have today. I mean, unless all of you all are like managing your earnings better than I am. Anybody here doing that? Okay. So like assuming that you're not, by the way, applicable not only for people, applicable for corporate treasuries, applicable for DAOs, and everything that I've described exists today. So, that's like a multi-step forward, but, in terms, and I can't do that alone, and that's why, I want to work with everybody here in this room to get to that. Everyone has some part of that puzzle piece. But for us, our puzzle piece is, we develop a number of different products in private credit and private equity. And so, my focus recently has been, let's take the first step. Let's get our private credit on chain. So we recently tokenized one of our 9% yielding private credit funds on multiple different permissionless blockchains. And again, for those of you who have known me for the decade that I've been the queen of permission blockchain, you'll all be proud that I finally made it out, 10 years later. And now, after that first step, like it's the next thing, right? And by the way, like a lot of traditional players in blockchain think that tokenization is the end. But what they really don't realize is that it's actually just the first step. Like you get on chain and they're like, hooray, like we've tokenized something, congratulations, now what? But like, really the next step is how do we develop more compelling products? So as Nick from Solana mentioned, really focused on, how do we get this, private credit fund into DeFi protocols and make it, more mobilizable. I mean, and that's another thing as well. A lot of my job is actually thinking about what does the future look like? And how does Apollo win in that future? How do we take opportunities in the change? And how do we make sure that we don't get disrupted? And what's clear to me, and it should be clear to all of you, is that the next generation of investor is very different and from an expectations and activity perspective than current set of investors, right? Like clearly, especially in like the crypto native set, like not only do you want to invest and have yield, you want to interact with your investments. You want to, I guess I've been learning about looping and vaulting and like swapping, right? Like you want to get active. And so from my perspective, like, for Apollo, I want to make sure that I'm meeting the next generation of investor where they want to be, because the next generation, the crypto native investors today are the leaders of tomorrow. And, tomorrow you'll be thinking about retirement savings, and I definitely want to help you with that, but it will definitely not look like what it looks like today. And so this is also a process of discovery for us where we're learning by doing and iterating. The thing that we've put out on chain may not necessarily be the most perfect thing, that you all need right now. But if I put it out there and I go to, then we talk about why you're using it or why you're not using it. We talk about what you want or what you don't want. Then we can iterate and grow together and actually build products that you love and that you'll grow old with.
That was amazing. Thank you for that. I think, as we start to think about what that future looks like that Christine just outlined, obviously there's infrastructure gaps between where that is and where we are today. So I want to turn it over to our CISO and Chief Operating Officer expert, David, to talk a little bit more about the mechanics of staking, the mechanics of security and operational risk management, when exploring staking and exploring sort of this on-chain DeFi future.
All right, now it's time for the doom and gloom and how North Korea is going to steal all of Christine's wealth. No, but the reality is,
Save me, protect me.
Exactly. The reality is this is a risk-based decision, and for all intents and purposes, the infrastructure for staking remains the same, whether it's pooled, whether it's liquid, whether it's native protocol staking. And just like from a brokerage perspective, you can have an introducing broker who chooses to leverage a carrying firm for their clearing and settlement. It's the same sort of decision that goes into play when you're thinking about staking. It's whether or not, from a risk perspective, and I don't just mean from security, it's operational risk, it's legal risk, it's technical risk, it's a cost-based decision of whether or not this is something that you want to take on yourself, stand up your own staking infrastructure, or whether or not you want to leverage a partner, just like an introducing firm would leverage a clearing firm for their, from on the brokerage side. So when you look at the infrastructure, you have things like smart contracts, you have, from a technical perspective, whether you're using cloud assets, whether you're using stuff that's on-prem. There's, from bringing back to my earlier point about the risk, it's really understanding natively how staking works on all the different protocols. And it is different. ETH staking is much different than Sol staking, even though they're both proof of stake. So I would implore everybody to really not dive into like the technical deep rabbit hole of how all these things work, but you really should understand the basic tenets of how staking works from a smart contract perspective, from a validator, from a proposer. You really should understand how everything works and then make a risk-based decision of, am I going to be doing my own infrastructure? Am I going to be leveraging a partner to help me stand up my own staking infrastructure? Am I going to be leveraging pooled? I'm going to be leveraging staking. And again, the rewards and the risk kind of deviate from spectrum to spectrum as opposed to what solution that you're going to be looking for. And the last thing to leave everybody with is it really comes down to the same way you select any sort of partners from a due diligence perspective. It's don't just look at the yield. Like we got into trouble when you start looking at BlockFi back in the day of like, let me just go with the staking provider that's offering me the most yield because staking is staking and staking is inherently safe on the protocols because staking is staking. It's not. As I mentioned, from an operational perspective, there's different risks from slashing, there's different risks from a smart contract perspective, there's risk from a custodial perspective. So when you start thinking through who you're going to be staking with from a provider perspective, really, again, break down those different components, understand the risk, and really interview and do your due diligence on your staking provider and go with the best of breed. Just like you would with any other partner that you choose to work with, don't make the mistakes of people in the past and just go with, who's going to offer me the most yield.
Great, thank you very much. I've got one final question for each of the panelists. I'll ask it to every one of you. Sort of, what is like the dream security, regulatory, consumer adoption scenario? Sort of one thing that, if it happens this year, you really think it makes or breaks your firm or your approach to digital assets, and really would open up the door for broader adoption. Ed, I'll start down with you, and we can work our way this way.
That's a tough one because I keep thinking about the investor of the future that Christine outlined, and I think that's where this industry is going. Self-directed retail is here, and you all might be part of that self-directed retail group that says, these are the assets I want to buy, these are the assets I want to put in my brokerage account, and you can't really see your digital assets in your same portfolio all the time unless you have a layer that kind of consolidates them or a financial advisor that consolidates them and allows you to risk manage that holistically. So when I think about what could happen this year, the regulatory and congressional bills that pass from a stablecoin perspective might be revolutionary because it will allow for some of those swaps to take place. I think that pulls things into portfolios, which can then be risk managed. And of course, if we can get staking in an ETP, I think that opens up the gates for now the ETF wrapper to be the tip of that spear from a traditional finance perspective, where capital allocators can go to get exposure. And once you get them in the room, the future that Christine described becomes what we will all define as the future collectively.
Yeah, I mean, like for my part, I think, in whatever form it comes, whether or not it's what I described or something else, like having people understand very clearly why are they doing things on a blockchain, why are they interacting with tokenized assets on a blockchain, that it is definitely 10x better in some way that matters to them. I think that's important. It's taken a long time, but it's only taken a long time because the technology infrastructure had to be built at the foundational level, and it's still, is getting refined. But a lot of work and thought was put into all of the potential use cases, all of our enterprise blockchain dreams, which I know many of you in the room, experienced with me circa 2017 when we thought it was blockchain, not Bitcoin, but we were wrong, obviously. All of those dreams are now able to happen with the technology that exists today. At that time, we were waiting for the technology. Now the technology is here. Many people just got disillusioned because it took a long time. But now that we're gangbusters, like, digital assets, it's open for business in the United States and around the world. Now is the time to resurface those dreams and put them into action and to, actually pioneer like new 10x experiences, like I said, that, benefit us as a community, as a crypto native community, but will also just be like the tip of the spear for everyone else that can, like all of the mass, users who actually don't care what the infrastructure is. Like nobody actually says like, I'm super excited about this application because it was using AWS cloud, not Google cloud, right? Like no one cares, but to build those experiences, end user experiences and outputs that people can benefit from. So that's what I think we need.
So longer term, tokenization. So I fully support of what Christine is doing. Use case, tokenization. Near term this year, I hope both stablecoin bill and also market structure bill get passed this year.
As the risk guy, it's not even so much around what regulation am I looking for. It's really more clarity from our examiners, from an understanding the actual technology itself. Because I think I don't know if it's just beaten down a submission from regulators over the years from working at GSIBs, but they really do bring a level of maturity to the space. And I'm really hoping that they really can understand the technology in a meaningful way. That the examiners that come in are actually help secure and kind of mature the space.
Great. Well, thank you all for joining us. This was a fantastic panel. Let's give them a round of applause.
Thank you.